Welcome to Morning Brief, Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Tuesday, 30th September. Coming up on the show, the Vice President signals that a government shutdown looks like it will kick in from tomorrow. We'll look into whether China can threaten the US's dominance in the world of artificial intelligence. And I'll tell you all about a stock that surged over 1,700% in less than 24 hours. So grab your coffee and let's own the morning.
I think we're headed to a shutdown because the Democrats won't do the right thing. I hope they change their mind.
We have very large differences on health care and on their ability to undo whatever budget we agree to through rescissions and through impoundment, as well as pocket rescissions.
So, no deal. President Trump failed to reach an agreement with congressional leaders last night to avert a government shutdown. Lawmakers have until 1 minute past midnight on Wednesday, or a partial shutdown will kick in. If a stoppage goes forward, in addition to mass firings and chaos at the airport, the government is set to cease publishing economic data at a time when the Federal Reserve and Wall Street have a particular need for it. Don't forget, on Friday, we're meant to get the crucial jobs report. As we've head to the last day of the quarter, which looks like it will be a record one for US stocks, the futures market this morning suggests that stocks will have a shaky start to the trading day once that opening bell rings. The dollar was broadly weaker against a range of currencies too. However, gold continued to surge, hitting another record high. The prospect of a looming shutdown has clouded the Fed's monetary policy path, especially ahead of next month's rate decision. Well, here's our very own Inez Ferre on everything that's driving the precious metal higher.
Massive monster rally that we've seen with gold this year, and today's all-time high prices as well because of the threat of a government shutdown. You've also had this year, of course, central banks purchasing gold, and we've talked a lot about that and the Fed easing cycle, which began this month. But look, it's really also the dollar weakness that has sent gold prices higher. If I pull up a dollar chart, you will see that over the last this past year, we've seen that the US dollar has gone down about 10%. I'm having difficulty pulling up that chart, but nevertheless, it's gone down 10%. That creates an outsized move really when it comes to precious metals. And I want to point out silver as well, because silver has actually outpaced gold. Silver is up 58% year to date. Gold is up 45% year to date. So we could be seeing a bit of a silver squeeze as we're watching right here. But nevertheless, this is not too far from silver futures all-time high closing back from 1980, when that closing was at 48.70. So watch out for silver touching record highs in the coming days and weeks if this rally continues. But as far as whether this is sustainable or not for gold, which is closely watched by Wall Street, look, Goldman Sachs has a forecast, a base case scenario forecast of $4,000 per ounce for gold by mid-2026. We're looking at 38.50 right now. So that would imply perhaps some pullbacks here and there. They have talked about speculative buying in recent weeks. So that's a risk to watch out for, because when you have that, then you may have some pullbacks along the way. But Goldman also sees a case for $5,000 gold, a bull case, by the end of 2026. So Wall Street is still bullish structurally on gold because of that structural demand that we've talked about that's been happening over the last couple of years, despite the fact that you may see pullbacks along the way.
Well, the first thing you need to know is that last night President Trump announced tariffs of 10% on softwood timber and lumber, alongside a 25% tariff on certain upholstered wooden products, due to take effect on October 14th. Canada is set to be hit hard by the order, as it's the US's largest wood supply and already subject to duties of 35.2%. But countries that have already carved out deals with the US have lower rates. For example, tariffs on wood products from the UK won't exceed 10%. Okay, the next thing you need to know about is the rising revenues at OpenAI. According to the information, OpenAI generated $4.3 billion in revenue in the first half of 2025. That's actually 16% higher than it generated in the whole of 2024. However, it did burn through cash, $2.5 billion, mainly because of R&D costs for developing AI and for running ChatGPT. Now remember that Nvidia last week said it will invest up to $100 billion in OpenAI and supply data center chips. The last thing you need to know about is that we have seen a record number of mega deals in the third quarter. In fact, yesterday's $55 billion leverage buyout of Electronic Arts helped take M&A activity past $1 trillion in Q3. Over the last 3 months, there were 47 deals that were made that valued more than $10 billion. Also, after last night's closing bell, investment bankers advising clients at Jefferies reported their best quarter on record, a performance that's reflected higher values on M&A deals and helped lift firm-wide profits by 34%. Okay, some breaking news for you now. And Bloomberg is reporting that ExxonMobil plans to cut about 2,000 jobs globally. The Texas oil company is looking to consolidate smaller offices into regional hubs as part of its long-term restructuring plan. The reductions represent about 3 to 4% of Exxon's global workforce and are part of the company's ongoing efficiencies drive. It's yet another sign of the challenges faced by the oil industry. Okay, we're heading for a break now, but rather than looking back, our very own Jared Blickery will help us look ahead to Q4. Stick with us here on Yahoo Finance. Welcome back. As we all know, this month of September and the quarter ending today have been pretty exceptional from a market's perspective, with stocks, gold and other assets hitting record highs, despite some warning signs. So, how should you prepare for the October trade? Well, our markets and data editor, Jared Blickery, crunched the numbers for us.
September was supposed to be the worst month of the year, and it's almost in the books, and it wasn't even that bad. Today, we're going to take a look forward to October, and we're going to be breaking down seasonality. So let's do that real quick here. Seasonality is the predictable and recurring changes in data that happen at about the same time every year. And we take a look at it sometimes a presidential cycle, it might be every 4 years, but the bottom line is we're looking for recurring patterns. And so let's start with this bar chart first that shows each month having a return, and this is just the median return since 1990. And the median is kind of like an average, except that it's not so skewed by large outliers or underliers there, to the upside or to the downside. And here's where we are right now. We're still at the end of September. As I mentioned, it was supposed to be the worst month of the year, but actually it was pretty good. And in fact, we were expecting the last 6-7 days to be all negative, and we got a few bouts of negativity in these days, and we still have 2 more closes to go. But nevertheless, we're probably going to close with some decent returns, at least in some of the indices. Now we can look forward to what is the most positive quarter of the year. And I'm going to be breaking this down in part tomorrow too, the fourth quarter. But today I just want to cover what's happening with October. And here's another look at the full year. In white is what has actually happened. And you're going to note here that this was a big post-Liberation Day sell-off and that quick recovery, which is one of the quickest returns to highs that we've ever seen in the market. And then I have 2 different models. One is a median since 1990, that's in green right here. And in blue, we have the median since 1928. And that is where each day of the week has to match what we are in presently. So if, for instance, it is Monday, September 29th, we just have to look at those Monday, September 29th throughout history, except we're mapping this into October. And you can see here real little that we did have this sell-off in the white line that kind of matched what we were expecting in that median since 1928, same day of the week. And that has actually become my preferred model. This has become a pretty good predictor of what's happening. So here we have that same model, median since 1928. And let me just trace out what we are expecting for the month of October. And you can see we rise pretty quickly in the early part of the month, and then we kind of drift lower into the end, but then we got a little bit of a bounce at the end. And we we also have that other model, median since 1990. That more or less kind of revolves around the unchanged. It goes slightly negative in the middle of the month and then delves into the positive towards the end. The point is, depending on how you slice and dice the data, you can come up with wildly different models. And so I'm not trying to confuse people, but there are different ways to do this. And so you might see some different seasonality results from different people who are doing a lot of these studies. But again, my favorite here is median since 1928, same day of the week. And for that, we are expecting some outsized performance in October. Now I want to move on to a different market. This is the VIX, and in white we have the average VIX since 1990, which is when it began, and then in green we have what's happened this year. And the VIX responds to volatility, and it's looking forward to options changes, basically what the options market is saying about changes in the S&P 500. And what sticks out is this huge spike. That was a Liberation Day spike that we got there. And what you're going to notice is even though the model, the average drifts up into October, and that's when we've seen a lot of market crashes throughout history, we've seen muted volatility so far. So the potential is for volatility to rise. We just haven't seen it just yet. So to review here, we have performance leaning positive in October. Volatility tends to rise. Notwithstanding that, I also want to point out that we have more than average trading days. Usually it's 21. We're dealing with 23 here. And also for Indigenous Peoples Day on October 13th, stock markets are open. Bond markets are closed, and your bank is probably closed too. So having said that, tune in to the next Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Now that we know what to expect for the month ahead, we're ready to dive into trending tickers and look at China's rise in AI with our live guest. That's just after a short break. It's time now for today's trending tickers, starting with Wolfspeed, a huge mover today. Look at this chart. After closing up more than 1,700% yesterday, the ticker WOLF, W-O-L-F, is up another 39% or so in pre-market. That tells you just how excited investors are after the semiconductor maker completed its Chapter 11 restructuring in court filings. Wolfspeed said it has cut its total debt by nearly 70% and will save about 60% on annual cash interest, and it's adding 5 new board directors. Okay, it's up actually just under 22% in pre-market now. On to Firefly Aerospace, which is grabbing headlines after a dramatic test mishap. Shares are down more than 10% in the pre-market after the company confirmed that the core booster for its Alpha rocket was destroyed during a ground test at its Texas facility, just weeks before its return to flight mission. Firefly said all personnel was safe and it is assessing the damage. The setback follows a prior investigation into an earlier failure. Remember, Firefly only went public last month in one of the most hyped IPOs of the year. Time for a quick look at Google's parent Alphabet. The stock is very much flat in pre-market, but the headline is worth noting. Google agreed to pay $24.5 million to resolve President Trump's claim that he was censored after the riot at the Capitol on January 6, 2021. This week, Google and other tech giants have also been dealing with the rising costs of H-1B visas announced by the Trump administration. The latest this morning is that many companies are considering moving jobs outside of the US to hire those workers in India or the Middle East. And while we're on tech stocks, there's a much smaller player that's been posting massive gains. SanDisk, the maker of hard drives, is continuing its rise in after-hours trading, now up more than 20% in the 2 days on a series of positive updates, including at a new lab in Japan and analyst upgrades amid strong demand for memory to fuel the AI era. Finally, Etsy, the online marketplace, is making a big move. Literally, Etsy announced late yesterday that it will transfer its stock listing to the New York Stock Exchange on October 13th and will stop trading on NASDAQ. Etsy said the switch won't affect operations and its ticker symbol will remain Etsy, ETSY. The news powered the stock up 15.8% yesterday, although it's giving up some of those gains overnight. Keep watching Yahoo Finance to see where things go from here. Can China threaten the US dominance in AI? Well, the Shanghai Composite China's mainland benchmark rose 3% in September alone, its longest monthly rally since 2017. Why? Well, Asian tech stocks have been on the rise. They've been benefiting from optimism around companies linked to AI developments. But is this optimism warranted? Well, to help answer that and more, I'm joined by Rick Carew, Adjunct Professor of Finance at Fordham University's Gabelli School of Business in New York. Rick, thanks so much for joining us. Well, let's start with that thought. Is the recent optimism surrounding these Chinese tech stocks justified at the moment?
Yeah, well, thank you so much for having me. You know, the Chinese tech sector has long been one of the most innovative. And I would say, even though it lags behind the US Silicon Valley giants, you can look at Alibaba, Tencent, and more recently, challengers like DeepSeek and ByteDance, which is the parent company of TikTok. And you can see Chinese innovation continues to go across the board. And while it may still be behind the US, it continues to also trade at cheaper valuations. And what you're really seeing this year is domestic investors really rediscovering the value of those companies. And, you know, the two bellwethers that I watch very closely, Alibaba and Tencent, Alibaba is up over 113% so far this year, and Tencent's up almost 60%. So what you're seeing is investors starting to rediscover the value in some of these Chinese tech giants that are making tremendous strides in innovation, and the government's also providing a bit more support for their entrepreneurs, which has not been the case for the past 4 years.
Well, you mentioned there Alibaba. Let's take a bit of a deeper look there. I mean, what do you make of its recent partnership with NVIDIA? How does that affect it? And especially as we know that Beijing has been telling tech firms not to buy from NVIDIA.
Yeah, it's been very interesting. You know, when you look at NVIDIA's presence in China, it's long been focused on selling to companies like Alibaba, Tencent, DeepSeek, some of these giants that use their chips. And Alibaba has always been a natural partner for foreign firms to work with in China. You know, they have an international style management team. They have a wide reach across the country. And so I think this partnership, which is mostly focused around robotics and some of those developments, while it's a good sign for both NVIDIA in terms of continuing to grow its presence in the Chinese market, it's also a good sign for Alibaba that they're continuing to be close to the cutting edge and in partnership with a global leader.
And there's more signs that NVIDIA is under pressure in China. We only heard this earlier this week that Huawei's going to try and double output of its top AI chips. Is NVIDIA in trouble in China?
Well, you know, there's kind of two levels to this. One is NVIDIA clearly has the lead in terms of technological development. So that's to their benefit. The challenge really is where they lie within the geopolitical game between the US and China. And one of the things that's really interestingly emerged is that Jensen Huang has become, the CEO of NVIDIA, has become a bit of a diplomat in helping to negotiate some of the trade issues around technology between China and the US. Now, in terms of the underlying business fundamentals, Huawei is making a huge effort. They have a huge number of engineers and other folks that are supporting the development of their chips. They've got all the resources you could ask for with the Chinese government support. But I would say that they're still several years behind. And so the cutting edge chips are still NVIDIA chips being used in China to the extent that they're available. And Huawei is, while it's making progress, it still has quite a ways to go in order to catch up with the cutting edge.
So, Rick, I've spoken to many company bosses in the tech industry, and recently you spoke to the president of Cisco, who said that the US was leading the way when it comes to AI. But where do you think China now stands in this AI race?
Well, there's kind of a joke that is going around Silicon Valley and Chinese tech circles that really what's happening is a competition between Chinese engineers in the US and Chinese engineers in China for dominance in AI. And I think there's some truth to that. If you look at the leading companies, you know, Jensen Huang is a Taiwanese American, and many of the, you know, one of the very high profile hires by Meta is a young Chinese developer. So, you know, their Chinese engineers are really leading the way, and the question is whether the U.S. with its immigration policies can retain a lot of that international talent in the U.S. and continue to stay on the cutting edge. There's opportunities in both Taiwan and in China for those engineers to do very well financially. So I think the competition is real, and I think it's important for government policies as well as for U.S. tech companies to really try to stay on the cutting edge and support policies that make the U.S. a global leader, not just a U.S. leader.
And Rick, while I have you, what about the IPO market in China? We've heard overnight that Xinjiang Gold, it's one of the biggest IPOs this year. I think they raised $3.2 billion, and it's done brilliantly on its first day of trading. What do you make of the IPO industry in China at the moment, and especially Xinjiang Gold?
Yeah, it's really interesting. Obviously, the price of gold has done very well, and so you would expect that to be a supportive environment for mining companies like Zijin. At the same time, one of the things we're seeing is Chinese domestic investors have really become more enthusiastic about the stock market and pushed up prices, but global investors have not yet really allocated to China in the way that they were pre-COVID. So we still see global allocations to China in the single digits, and that could give support for room to run for the market. And what you're seeing with the Zijin IPO, which is a Hong Kong IPO, is really targeting global investors, not domestic investors. And so in some ways, that and the CATL IPO earlier this year are helping to get global investors more enthusiastic in a way that domestic investors already are.
Okay. Rick Carew from Fordham University, the Gabelli Business School at Fordham University. Many thanks for your thoughts.
Thank you.
Okay, before we go, let's move on to check where the markets stand. Let's start with Asia, and Asian shares in the main were on the rise. Overall, this means that stocks in Asia will have risen for 6 consecutive months. That's their longest winning streak since 2018. And also, despite the manufacturing PMI, as we said, it came in below 50. That's the mark that separates growth from contraction. Chinese stocks did particularly well as well. Remember, there's a Golden Week holiday that starts tomorrow, so the Chinese stock market will be closed for the rest of the week. Let's turn over to Europe now. And stocks here have been on the downside, actually, but they've now started ticking green. Investors initially have been worried about those new tariff announcements from President Trump and what that could mean for the existing deals that the countries have in place. But it seems that they seem to have got a bit more clarity and that those tariffs won't exceed the ones that they've already agreed. OK, what about Wall Street? Well, futures, they're looking a little shaky, although shutdowns aren't usually moving events. This time could be different, as investors are already wary about a slowing labour market, the risk of stagflation and elevated stock valuations. I'm afraid that is all we have got time for. But remember, we have Nike reporting after the closing bell today. OK, well, stay tuned to Yahoo Finance for continuing coverage all day to give you best information on your stocks. I'm Ramzan Karmali. Go own the morning.